folks, it's Adrian, CryptoBirb speaking. Welcome to today's Friday webinar. This is a great day in Portugal, and I decided this is beautiful ocean place, right by the ocean, so there's lots of sun. Hope everything is going all right with you so that you have a lot of sun as well on your side, so that it actually brings a lot of cheer and smile on your faces. Let me know, everybody, how you're doing. And before we discuss actually the financial insights, and unraveling the crypto insights, as well as the traditional finance, well, make sure you stay tuned because we're going there right in a second. How's everybody doing? There's Queen, good to see you, lots of roses. Yeah, beautiful flowers, well, good choice. Matisse, hey, let's go, man, let's go. Good to see you. Django Blue, there we go. Hi. Yeah, hope everyone is doing okay. Let me know real quick how you guys are doing in the comments. Drop some notes, where you're writing from, how you're feeling, what's the temperature up like, if it's a good temperature, if it's good weather, if you like it, if you hate it, just tell me whatever. I really want to know your opinions, your sentiment, your mood, your attitude for today. It's critical. The attitudes, the moods, the weather also impact our perceived reading of what the reality is, of the reality around us, including the financial markets, right? So it may happen that one time when you wake up and decide that the mood is good, that the weather is good, you may see the market in more positive looks and more positive terms, right? So it's pretty interesting how it works. I'm really curious how you guys are doing. So let me know again. And by the way, if you're watching that in YouTube, you're in the right place. If you're watching that on Twitter, you're in the right place as well. We should be streaming that also to Twitch. So hi to everybody also on the Twitch. So good to have all of you up here, right? Because there's been choppy week, there's been choppy environment that actually is something that if I were to choose if I like it or if I don't like it, I would say I do not like it, right? Anyone who trades the trading range inside of a kind of like a boundary set, of prices, should be very happy, right? Because the prices bounces back and forth, between the same frames, same levels. However, it's a daily environment for trend traders, just like myself, right? So we suffer a lot. We suffer a lot of chop, a lot of small, tiny little whipsaws and losses on the stop losses, right? So, however, the protecting the capital is also important right there. So it's good to have those stop losses. Okay, so let's actually, João Conde, good afternoon, João. How is it going? Beautiful place up here. Yeah, without further ado, I'd say we should actually go ahead and jump right ahead. Scottsdale, Arizona, Francine Voyadzek. Boom. That almost sounds like some Polish fruits. I might be wrong about that, of course, right? Voyadzek sounds very interesting. That's a very good, beautiful name as well. Hello from beautiful sunny Scottsdale, Arizona. Triple digits temperatures. Triple digits. Imagine triple digits in Celsius. We couldn't live with that. So I guess it's super hot already, over 100, in Fahrenheit. So it's gonna be hot. The formula is, as far as I can recall, 32 degrees plus 9/5 of the Celsius, if I'm not mistaken. So it's gonna be hot, probably, right? Either way, we should get it going, right? We should get it going. By the way, before I go, Scottsdale, Arizona, I just recalled what I wanted to say. Scottsdale, Arizona have the beautiful parrot oasis. Many times in the past, we've donated a lot of money to the parrot sanctuary, parrot oasis. Now in Arizona, it's Scottsdale, right? Not many, I guess, countries, not many places would have those beautiful sanctuaries for parrots, and parrots are actually, very often an endangered species as well, right? So my whole word is about parrots. My 3 parrots, cockatiels, are sitting in a cage, and I really hope they would not stir up with the mess behind my back up there on the noise side. So I need to be fast. I need to be quick and swift to get it going. Hi, Rick, my man. Good to see you. Good to see you, bro. Good to see you. Time flies so fast, right? Doesn't it? Gorgeous here in Victoria, BC, Eastern European. Excellent. First question, how long do you think it will be until we reach the resistance again and peers? I'd love to answer that. This is a very good question, and I love to have a crystal ball to tell you 100% certainty. I'd say I have no idea. But let tell you what, the good thing is that we can have a look at the charts and focus on the facts and try to figure it out. So that's what we're going to do in a second. Queen hot girl season, that's about right. Let's do it. Let's do it. So markets have been choppy lately. There's been a lot of sideways. There's been a lot of, I'd say, native sideways environment for the past couple of days, right? The July side, typically is not so bullish for the traditional finance for the stocks, right? In fact, Nasdaq is typically starting the worst 4 months of the year in July, right? So anything basically, taking you from July to through October is not going to be too much beneficial. For the aggressive risk on stocks, because summers tend to be slow, summers tend to be sluggish. Not many people trading at the computer screens, right? So overall, it translates lower volume, less demand cushion, and bigger chances that the prices do not find a lot of follow through, and instead they kind of like stall and rest sideways or just fall, right? So we are having a little bit of a downfall for the past couple of days with a little bit of a island reversal pattern up there. Island reversals are not really good because they really come in as those exhaustion patterns, right? So these exhaustion gaps, when there are a lot of gaps kind of like come in one after another and they close on the next days or just soon after, I would argue that these are potential reversal kind of like a setup. So you have to be very careful with them. Right, Nasdaq. See how nicely Nasdaq is doing. The Nasdaq Composite Index. Just have a look. It's super strong. It's way stronger than actually the Dow Jones Industrials up there. Right, it's super strong. 13,750 is actually right now. It's consolidating right now in this beautiful local kind of like a pennant. If I were to call it a pennant, that would be a pennant, right? Just some short, swift, small consolidation and in a strong upward trend. 20-day trend in the green line, 50-day trend accelerating. See how fast it's actually growing, right? Versus what it used to be early in this year, right? See how the slope accelerates up there, right? It's an accelerating trend on the 50-day basis, and also the 200-day trend started picking up consistently for the past month, right? So even more aggressively, I should say, because it's been going on to the upside anyways. So there is a decent boost acceleration on the risk on side, on the tech side, on the composites right there, which is good, which is positive. And well, basically, wouldn't it take us to, if we were to give it give me a decent look, right? So we are not so far from all-time highs overall, right? We have a way to go, of course. However, it's a good direction. So, well, having a deeper look into industrials, right? What we're looking at is typically we want to see the coverage, the same convergence on the Dow Jones Industrials and what the transportation is doing, right? Transportation is discretionary. When you have a lot of money, you can spend money on transportation. You can spend money on durable goods, on buying cars, Teslas. That's why Teslas are picking up nicely in the past months, right? Risk on environment is typical and aligned well with the transportation average. So the Dow Theory, the very foundation of Dow Theory, says that you have to watch for healthy trends when the averages confirm one another. When the healthiest trend conditions are sustainable, when the averages confirm one another, right? So we have to see the same types of movements. So we were looking at a consistent, continuous strength on the transportation side, right? Kind of like reaching almost, into the early highs, I would argue, right there, right? And at the same time, we're looking at a little bit of a slowdown, right? It's not pushing that. The industrials are kind of like stalling right now at the previous resistance. It's not too bad because it's still more bullish than not the average 200-day moving average trend. The primary bull market is here, right? It's not my opinion. It's just the average is going up, and if the average representing a bull market or a bear market is going up, then it is a bull market. So this is a slow, early stage of the new bull market for Dow Jones Industrials, and definitely, strong push, even stronger on the transportation side. So ideally, the averages confirm each other. So I would say we have to be careful. However, it's good so that there is a lot of momentum on the discretionary side. Right, on the S&P 500, what we're looking at, again, there was a little bit of a downfall. Again, you have to be careful with those tiny little gaps. They are they are suspicious, right? They are suspicious. Those tiny little gaps that I'm talking about, if they get close on the next day or soon after, typically that represents exhaustion, right? It's a little bit different than this or than this. So if you have a look, right? If you have a look up there, those types of gaps, those are breakaway gaps when they break away of a critical resistance. So you have some chop going on, some sideways, and there is a gap just basically on the, typically after weekend, and this gap kind of like breaks away, out of this entire cluster. This is what typically represents a lot of power, a lot of strength, and a lot of breakaway momentum, right? It's different when there's a lot of chop, when the conditions are not really, looking good anymore, and there's a lot of sideways gaps that tend to get filled within the same week or day, etc. Right? So this is typically separating this cluster as a little bit more distribution phase. So I would be very careful. Even though we had an excellent, amazing technical setup right there with a perfect breakout touch point retest to the point, literally to the previous resistance, that turned into support at 43.25. It's a bullish case. We continue to make new highs. However, you have to be careful because summers are slow, and we are printing some exhaustion marks, right? So there might be some correction ahead. Be careful and be mindful about that. Otherwise, we're in the bull market again. Just if you were to disregard all of the candlesticks and just focus on this beautiful trend line, this 200-day trend line, this represents a bull market or a bear market. If the line is decreasing, it is a bear market. If the line is increasing, it is not due to accident, right? You cannot have an accidental price movement that is consistent for the many months, right? Now, it's impossible to grow on average for 6 months or so, coincidentally, right? It's just, that's not how it works. You can be up and down on one day. Like random means 50-50, right? So you wouldn't see trend, you wouldn't see follow through, you wouldn't see ramping up kind of like velocity up there that you're seeing otherwise, right? So we're on a trend, and the trend is uplifting, it's bullish. So we're in the bull market. It's simple, and that's not my conclusion, that's not my opinion, it's literally what's in the chart, right? So I have no ways to tweak it, I have no ways to basically, fake it. It's the chart right there, and I'm just commenting the chart, right? I'm saying the line is going up because the line is going up. So that's not my opinion, it's a fact. Yeah, let's see. Does this, wow, there we go. New highs made on the XLY versus XLP ratio. Relative strength ratio is important to observe and to watch because it shows the risk on, risk off environment. And this has been printing to the upside, ladies and gentlemen, very strongly ever since 2023 rotated and came in. The markets rotated. That's why I called it a market rotation, because the XLY continuously outperforms on average, the XLP, right? There is an uplifting trend, higher highs and high lows that are continuously and consistently made. The 200-day trend, relative trend line, is still yet to catch up. However, it's shifted. It's not bearish anymore. It's kind of like stalling on average. However, this is it's a matter of time until it starts climbing up, right? Because eventually you're looking at a very strong confirmed follow through, higher highs, higher lows. This is a beautiful example of a consistent uptrend, and it's actually right there. Attempting those kind of like previous highs, right? So of course there are no ideals. The trends are fractals. The movements in financial words are fractals, so they are not ideal. They are far from ideal. They are far from theory. It's good to know theory, however, the practice shows you a little bit of different noisy fluctuations, and there's a lot of entropy. However, arguably, we are in the zone where the relative strength ratio that can be interpreted in a similar manner than just the prices, the nominal prices, is in the so-called resistance area. However, the whole beauty of these kind of like support resistance, heuristics, those rule of thumbs, is that they are not obvious at all. We are certain and obvious only in hindsight, right? So we have no idea to expect or to tell you, okay, that this needs to stop right now because it's in the support or resistance. The markets don't care about that, right? It's just a place that often finds some congestion on one side or another. However, it doesn't have the magical forces that you just touch the point and it just magically flips the switch and it just turns back around. So that's not how it works. Right? There is a process, there's time, there's people, there is emotion behind it, behavioral biases, so there's a lot of irregularities up there. So be mindful about that. However, it's a direct confirmation that the market is not bullish ever since, is not bearish ever since 2023 started. The markets have rotated to the upside, and risky environment is outweighing by a lot consistently the risk off. The traders do not fear anymore. And the energy is actually, I'd say, it's just experiencing a little bit of an upward pullback, which is interesting. Taking into consideration that we are spending so many days already up there, right? So I think it's going to be soon about 65, 70 days that we spend up below the 200-day moving average. That's the last time it happened. It was in the bear market. So obviously there had been a ride for 3 years almost, right? 2-3 years of very consistent, strong upward movement with a breakout from the COVID year up there. However, the move seems to have expired, right? Of course, there was a lot of kind of like war, I would argue, war period that just gave a lot of mark right there, right? When the energy prices just, grew 100%. Right, the energy stocks just on average on the ETF average just moved up 100%. Right, so it's I wish to say that I would love to say that the trend is bullish. However, it is bullish, yet it's strongly weakening. It's weakening by a lot. It's sharply weakening. Okay, and how do I know that? Is by observing the relative strength ratio. So XLE versus SPX S&P 500 ratio index. We're looking at continuous downward trend on the relative strength. That tells you about the preferred choice by the investors. So the investors prefer not XLE, but SPX. So the SPX, which expresses the risk, actually is kind of like this wartime, recessive war, deflation or disinflationary environment for the tightening, etc. This is typically when the energy grows. This is what puts an end to the financial markets typically when the energy. Let me show you. Let me show you. So it's going to be on their come on performance charts, right? It's going to be here. So the typical model, market rotation model, is up there, so that the markets, the orange curve leads the economy by 6 to 9 months, which means that in 6 to 9 months you have of the time between the critical peaks and troughs and valleys, right up there. So this is the 6 to 9 months on average that you can expect that if the markets move up, the economy will react 6 to 9 months from then. If the markets move down sharply and fall into the bear market, you will start feeling economic consequences and effects of that 6 to 9 months later. And the energy is typically what peaks out the financial cycle, right? This is what slows and stalls and reverts potentially the economic curve, the business cycle, right? So when you see energy shooting up, it's typically something that you want to be careful and mindful of, right? So I would say, again, the market is taking a lot of ease right now. We've paused hikes, we skipped the hikes. Lately, there is still, of course, some potential hikes, hiding around the corner. You cannot be sure of anything anymore. However, we're looking at a 200-day trend, which is slowing. We're looking at 60, 70-day time period spent below the 200-day moving average, continuously underperforming. And even though there's a little bit of a, just maybe like an inverse head and shoulders or whatever you name that, I could find many, many ways to frame that pattern, right? And what I would say is that, of course, here, just notice that the horizontal level up here could potentially align well with the actual horizontal fraction of the SMA 200-day moving average, right? So I would argue that we are right at the resistance, right at the critical resistance. There's a lot of magical thinking that traders would apply, even though it's irrational, right? We do not focus on why things work. We just focus because someone said it, or like you buy support or sell the resistance. Why not the other way around, right? Perhaps actually the other way around is so much more profitable if you think about that, right? Buying into a trend extension, buying high, and selling higher high is more profitable than buying low and selling high, right? Because this expresses the chance of developing fat tails in the market, so-called trends, the directional price movements that tend to persist. So here again, I would say we are in this local cap, kind of like a rounded formation. We may or may not literally break out, and until it does it, we can never be sure of anything. However, what I'm saying is that we are spending 70 days below the 200-day moving average. That's what matters. I have no idea what's on the right side, right, of the chart. That's where the opinions reside. However, if I focus, and I do love focusing on the left-hand side, this is me commenting that 70 days we've spent below the 200-day moving average. Well, this is rather bearish, much more than bullish. And even though we may see slowdown on the risk side, right, there might be, again, of course, the energy do much better in the winter time when there's a lot of energy consumption and a lot of heat consumption, etc. So the summertime is typically not the easiest, I guess, for the energy stocks. Overall, I would say we have to be careful because the preference may swiftly change if we are to expect little slower markets and corrective environment for the risk assets. Then it could translate to slower energy, to a little bit stronger energy. So I would, again, it's a coin flip. However, on the relying on the facts, we're losing steam, right? Significantly. Not to mention the purest fact that we've stopped moving up, basically, right? We're not moving up anymore. We're moving sideways at best, right? So that's the reality. We're moving sideways at best, right? So that's the range. That's the trading range. So I would say that being here for the first time in a long while since the last bear market actually marks potential willingness of the market to go down eventually, right? The market is telling you the story. The market is saying, I don't want to be on the bullish side anymore, right? Who knows? Perhaps it will change. That we cannot know. So what happens is if the energy drops, and this happens is in inflationary environments. So as soon as the Fed and FOMC starts withdrawing and backing off, from tightening and introducing any federal rate hikes, which I'm pretty positive arguably that they would do. They've disrupted a lot of economy already, right? So I'm not sure how much longer they can take it within the same frames, right? However, cheaper energy overall means more money in your pocket, more disposable income that you can spend also on investments, on companies, on products, on services that empowers the business cycle, that improves the economy, right? So the cheaper energy improves the economy. Cheaper energy is inflationary. Cheaper energy means that you have more money to invest in crypto. So, and cheaper mining fees for Bitcoin miners, right? So it's overall good. So even though we've been stalling a little bit lately, by the way, let me know, guys, if you can see and hear me properly still. I hear my birds chirping, so we'll have to live with that for a couple of minutes. I'd love to cover that real quick, right? So Bitcoin is actually dependent on the energy prices a lot, right? The energy peak, let's have a look. The energy peak, right? When was it? The energy peak was November 2022. Let's see what happened on November 2022. On November 2022 happened, well, guess what? The market bottom reversal, right? So the moment that the energy peaked, Bitcoin reversed to the upside. So there is some good indication, right? Inverse relationship most often than not. So the S&P 500 is right now strongly positively correlated, 0.56 right now on the ratio, on the positive correlation ratio scale up there. And it's like I said many times, most of the time Bitcoin likes to stay positive, right? Bitcoin likes to stay in the positive side. Let's take the past whatever amount, right? So very big majority of the time, the market, the Bitcoin is on the positive correlation side, right? This is where the congestion is. It's mostly positively correlated with the S&P 500, and it rarely ever actually prints in those negative correlations, those inverse relationships, or what many people mistakenly will call decoupling, right? The markets rotate, the markets are dynamic, so we will come back and forth, it will fluctuate, it will change, it will never decouple, right? It will never decouple because it's dynamic. So every single time, maybe not in every single time, there are no 100% ideal win rates. However, quite often, more often than not, the times that we actually saw big, massive spikes to the downside on the correlation scale, Bitcoin actually put in the bottom, right? So let us have a quick look up there, right? Up there, right? There was a little bit of a bottom up there, strong spike, bottom, market bottom. Another one, boom, another one, right? DigiCarry, another one. So that is about it, right? It is something worth taking account of, or taking into consideration. We're right now stalling at a area of, again, so-called resistance. You can never be sure if it's resistance until it breaks through or rejects, right? Because how could you know the future? You cannot. However, what matters is focusing on the left-hand side. On the left-hand side, we're looking at 100% growth for Bitcoin, right? Ever since the bottom. That's the fact. That's the reality. The reality is that the moving average is respecting the high time frames, like 200-day moving average, the red one, or sorry, 200-week moving average. 200 weeks of data is actually right now 26,823. It's strong and it's growing. The 50-week average, which is super insensitive, started growing to almost 23,000 as an arbitrary level of long-term value, right? We're well above it. We're well above it, making new highs, stalling a little bit locally. However, it's overall bullish. We are in the bullish mode. We're in the bullish trend. The averages are rising. So this is a bull market, and the correlation is improving, right? So right now, right here, knowing that the breakout was confirmed, that the breakout was valid up there, giving us 28% boost from 24,800s all the way to 31,500, you know, to 600 billion asset doesn't move by accident by 30%, right? It's impossible for someone to pour in $200 billion by accident into the market, right? It's impossible. So having so much credibility, we're looking at the local sideways environment, local sideways theme. So this sideways theme is not really good for trend traders like myself, right? We get chopped a lot on the sideways, on the whipsaws, on the top, on the bottom. However, it doesn't matter, because what matters is that this 200-day moving average inclines, it grows, it rises, and it gives you arbitrary magnet level, this anchor, this framing effect, anchoring effect at 25,122. This is the potential level that you could expect the prices to bounce off at one point. However, note that this is dynamic. At one point it was 20K, now it's 25K. So for the sake of 3-4 months, we've grown by 25%. Right, by 25% on average. That's a lot. That's a lot, right? So whatever we do, the consolidations in the bull markets are typically bullish, or more often bullish than not, because the bull markets tend to persist higher, and the consolidations typically tend to resolve to the upside as well. Will this one resolve to the upside? I have no clue. I have no idea. I wish I could tell you that, right? However, the statistics are our friends. So statistics is your friend, right? So here again, focusing on the left-hand side, giving up on what's on the right-hand side that I cannot know or control, possibly. You're looking at the trend that is improving, that is accelerating, that is changing again. The market's bottomed up there, you know, it was flat, it started growing a little bit, you know, since the 20K breakout up there, you know, stalled a little bit, then it gave a decent shot, you know, boost, and boom, 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 boom. It improves, grows faster and faster. When the average grows faster and faster and faster, this is a sign of inclining momentum, of strength, of technical power, whatever you name that, it's bullish. So there is not a single person healthy on mind that would call this trend bearish. Bearish, or being a bear market, this is a bear market. Bear market means the primary trend, the primary Bitcoin movement, the primary ascent of price moves down. If it moves down consistently, this is a bear market. If it moves up consistently, then it doesn't matter what was on the left too much, right? Because we cannot get stuck in the past. We cannot live by the past. We cannot make money sitting in the past, because we're disregarding everything that is going on right now. And what's going on is that Bitcoin's grown 100% in just a few months. That's what's going on. Right? The trend has changed. So overweighing the past, conservatism bias, is not going to give you money. What gives you money is relying on the facts. The fact is that a trend is upwards. That's the fact. Right? So system is confused. Like I said, I've actually got stopped out overnight. I still need to put out an update on Twitter real quick. However, I got stopped out overnight with a breakout to the downside. We're working on a couple of improvements to the Bermuda Pro, actually to my private trading system, so that it's even more viable, so that it works even more swiftly and adjusts even better to sideways environment, because trend trading in sideways is a hell. We don't want to trade too much, right? Because there are a lot of whipsaws, and it's a little bit of like a coin flip. You don't control what's going on. You know, there's a news, there is no news, whatever it happens. typically lacks a follow through, lacks a follow through, hence promotes sideways and trading environment, trading range environment. This is limited ways to make money, limited region to make money, because you can only make so much money when the price is capped inside a pattern, right? I make money on trends. I make money by purchasing up there, which was 26,500, and it was an open position all the way up there, making and cashing 65K on the profit. Perhaps prematurely, perhaps I'll need to close the deal and get into market again. Right? However, for now, the signal's just left the base and it's bearish for now, and it's trading below the critical baseline up there. All right. So let me give you one final thing. So if I were to give you, where is it going to be? Is it going to be this one? Let's see. It's gonna be this one. So that's the same chart, you've already seen it, that's the chart, right? So again, to Bearbricator Pro, my private trading system trend line is accelerating again after a period of two-month correction here sideways. The trend is accelerating again. How do I know that? Well, because the line is moving up, right? So it's not my opinion, it's a fact. And differentiating between the facts and opinions is probably what makes you money. So the trend is up, so overall, eventually you have better chances than I was expecting the market breaks up. However, we focus on relying on the facts and focusing on signals rather than guesses what's coming next, right? So that's why you have to have a system. That's why you have to have a reliable system, which is the one that I'm using with Bearbricator Pro for the current time frame trailer and high time frame trailer. And like I said, we're introducing an upgrade even deeper and better. So it's going to work even better soon. So guys, real quick before I jump off, if you go ahead and check my Twitter profile, I have a pinned tweet right there that is actually talking about the choosing ideal size. And frankly, it's super not obvious. It's not obvious at all. It's difficult. Sizing your position is arguably one of the biggest challenges that you're going to have as a trader. And you may find some replacement formulas, some simplify whatever gimmicks and tricks you find on the first page of the Google. That is not really the ideal situation. There are whole books and whole academic studies that have been going on for many years on how to select the best portfolio allocation, how to weigh in your risk, how to measure your risk, how to decide what your best portfolio allocation setup is depending on whatever stocks you want to hold, etc. There's a whole math, there's a whole stats and a whole academic engine behind it. Many techniques would rely on heuristics, such as 2% risk rule, right? So how do you exactly know why there's 2% risk rule? I mean, I know that, right? Because I'm lucky enough to have acquired a CMT charter holder ownership, right? So I can talk about that happily, right? However, there's this 2% risk rule that is typically answering the statistical theory of runs, right? So that it minimizes the 2% risk. It's kind of like a sweet spot and practice, maybe a little bit less. However, it's a decent anchor for you to take and learn from and take it, to minimize the risk of ruin and accounting for the theory of runs. $100 amounts, $100 stops, volatility depending on standard deviation if you're fundamental analysis, much more, or the ATRs, risk of ruin, theory of runs, optimal F. Kelly formula, maximum drawdowns, maximum negative excursions, right? So you can access so many more techniques to weigh in and measure your ideal size. However, I'm giving you a chance because if you do not know any of these, you can always come in and use my free position size calculator that I use for my trades, right? So I actually have it up there. I use it every single time. So if I want to go and use my, ask myself what position I want to enter, then I just basically press in the enter, the stop loss, the entry price, the stop loss, and the actual setup for the potential target. However, trends have no targets, right? And then I just increase my my box to the big size, and that's what I have. Account balance that I can introduce risk per trade, how much risk I want to make. Again, 2% risk rule. Margin, how much margin I want to have. How much position size if I use trading leverage. Risk to reward, estimated P&L, ROE, etc. So that is doing everything in a second. So imagine I wanna trade 10 whatever millions or whatever the number is on 1.8% and 2 times 125 one leverage, or maybe 2x leverage. So what's going to be my position size? Well, my position size is going to be 5243460, right? And margin is going to be twice as much, twice as little. So you can get this and get access to your profitable trade calls with this link. So you can go ahead under my pinned tweet at the Bird Nest, or that you're going to land at thebirdnest.com/Bybit. If you go ahead and click on the link, it takes you to our partners page with Bybit, and you can actually we roll this nice deal with them, so that you get cheaper fees, you get cheaper works with them. You get trading bonus up to $30,000 up there, and you actually get follow the formulas. If you deposit some amount of money, like $100, you get a free monthly subscription to the Bird Nest, calls only, right? So you can get the more you deposit, the more you can unlock, and basically you can acquire your worth of 1428 for calls only, for premium calls that are profitable, that are rolling in daily nicely. We have a lot of those calls up there. I post my trading updates up there. You have a lot of calls that are automated, that are profitable. Trading Time, Jay, has been really knocking out trades like crazy lately here on the legacy side as well, if you're up there. So there's been a lot of profits, a lot of gains being made. Go ahead, you can get this annual position size calculator for free, and it's pinned under my Twitter. So go ahead, go there, and well, I've been your host, Adrian's doing Tricks CMT. All the beautiful love from Ariseta. I'll try to answer some of your questions in the comments. So hit the subscribe button, smash the notification bells, hit the like, drop some comments and questions, and I'll, again, make sure to answer them along with my team. God bless you all. See you around, and have a beautiful day.